You are listening to Keystone's Stock Talk Show, episode 177. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We are back, having just recovered from our first week back at school and our collective laughing fits at Brennan's favorite movie, The Reveal of the 40-Year-Old Virgin. This week, we will begin with a brief discussion of what is to come and what we're doing heading into this fall. Myself and Aaron, what we do know is we're heading to Toronto at the end of this week to speak at the Money Show, and we'll talk about that briefly. We have a big stock debate for you this week. Myself and young Padawan Brennan, what's his name? I don't know.
That's my name.
That's a Star Wars reference, Brennan, not Star Trek. We'll face off and present the bull and bear cases for Leatt Corporation, symbol LEAT on the OTC, and an award-winning personal protective equipment company for participants in the motorsport and leisure activities market worldwide. The coin flip dictated that Brennan take the bear case while I will ride the bull case to almost certain victory. Aaron, who, if he checks his bank account while we're reading this, should be very happy to serve as judge, jury, and executioner. Following his execution of Brennan, Aaron will tackle our next legendary investor, Charlie Munger. While known to be combative, hopefully he will not literally tackle him, as he is 5'8" and 98 years old. Charlie is widely known as vice chairman of Berkshire Hathaway and Warren Buffett's right-hand man, but there is more to him than this, and Aaron will delve into the details. Finally, Brett answers a listener question on MAGT Forensics, Inc., symbol MAGT on the TSX, and it's for real this time, not just a head fake from the intro. MAGT shares jumped sharply in 2021, but have had seen a steep decline from last summer's highs. Brett takes a look at the current fundamentals and the outlook for the developer of digital investigation solutions for more than 4,000 enterprises and public safety organizations around the world. Let's get into our show this week, welcoming my co-host Aaron and the Killer Bees, Brennan and Brett. How are you guys doing?
Doing well.
Good. Are you able to breathe out there, Aaron? Vancouver,
it's pretty bad. So you were saying before the show started, worst in the world yesterday. I didn't know that.
Yes.
Actually, I was on the island. I assume it was the same. So I was on the island this weekend.
Hideous.
And it was quite visible in the air, obviously. Although I didn't have any issues breathing or walking around. Whereas in the past here in Vancouver, it gets so bad you don't even really want to leave your house, right? Quite a bit of smoke.
I woke up Sunday morning. I thought my son had taken up cigar smoking because it was just like and just chain smoked all over our room.
Hopefully, it's just cigars, right?
And
we were back in Bally's in Vegas.
Yeah. That was bad. The only time the air quality I think has been worse is the last time I was in Toronto and I shared like an Airbnb with you two. That was some worse air quality. Outside of the room, it was fine. Or the place we had. Actually, that place was pretty nice.
You're not lying, yeah.
Yep.
On either of those things that you said.
Let's not talk about inside that room ever again. Okay? So do we want to get to some news of the week? We have there's interest rate hikes. I think we got a few comments there. Aaron, do you want to start?
Yeah, 75, another 75 basis points last week. This is also telegraphing that forecasting likely that there's going to be more increases in the future as well to try and get inflation under control. So wasn't completely unexpected. I don't know what the street was expecting, but we're going to be seeing inflation numbers out soon for August anyways, tomorrow as of the time of this podcast in the US and the next week for Canada. So we'll see. We've recently been seeing some month-over-month declines, some flattening. So we'll see what happens there. But Canada has been losing jobs over the past couple of months, and this has caused the unemployment rate to increase. But the labor market is still extremely tight. So the unemployment rate in Canada right now is about 5.4%. That's almost still a record low. It's a little off the record low, but it's very low. Should still be considered full employment essentially. So, we'll just have to wait and see. As we've said before, there's probably at least a couple increases in front of us, and there is a light at the end of the tunnel, but I think that it's not necessarily. I think it's a little ways down the tunnel as opposed to right around the corner.
Yeah, I mean, we talked about the speech that the Fed chairman gave at Jackson Hole, and how the market was kind of surprised at the strong tone that they had in terms of curbing inflation. I don't think they should be surprised. They were behind the curve on that, and they really have to now get out and try to quell inflation. That is the main goal right now. So I don't think we were at all surprised to see the hike. So, I mean, it likely continues until we see a significant period of declines.
No, absolutely. And of course, the purpose of the hikes is to put the brakes on the economy, right? So it's actually a good thing.
And they may go too far, which often
and typically they do. They do. I mean, that's economics 101, right? The economy is in expansion mode. It starts to overheat. That puts upward pressure on prices. You get inflation. Then they have to start putting the brakes on the economy by increasing interest rates, constricting the money supply. And that's typically what leads to a recession. So, which is what a lot of people are predicting. But, saying that there's going to be a recession sometime in the near future doesn't really tell you anything, because recessions come in all shapes and sizes. So, but anyways, to the point, it's, the taking some of the steam, some of the pressure out of the job market is exactly what the interest rate increases are intended to do. So you can't on one point be hoping for a lot of job gains, and on the other hand, increasing interest rates to pull back the reins on the economy. Of course, it would be great if you can deal with inflation without sacrificing any jobs. That would be the ideal situation. I just don't think it's necessarily realistic. Generally hasn't been in the past. The
questions we keep getting is, if there is inflation coming, what do we do? What do we do in our portfolio? And I think, I think we stress what we always stress: the quality of the companies that you put in your portfolio. I know at the start of the year, in the growthier area of our research, we were focused on companies with great balance sheets, creating good cash flow, and they had cash in the bank. Because if there is a recession, these are the companies that will survive and can come out on the other side looking better. And I think that, if we do see that going forward, that those are great companies to be well positioned in. And, we kind of reiterate the research that we put out earlier in the year. Those are the companies that we continue to want to buy now. When we're in Toronto at the Money Show, I believe we speak Friday and Saturday. So if you're in Toronto, if you're in that area, come out. We'll shake your hand. We haven't been able to do that for quite a while, but it's great to get out there. We'll come out and talk to any clients that are in that area, or anybody who wants to talk to us about being a client, or just, talk about our research in the markets. We're going to highlight some research we put out to clients a couple of months ago in terms of looking at the entire tech sector, taking the pulse of where the valuations were then, in terms of historical numbers. And we're going to talk about that essentially in our talk there, and talk about some of the companies that we kind of put out a couple months ago to our clients that offer good value, and we continue to like those companies going forward. So that's what we'll talk about at the Money Show. I think it'll be quite an interesting talk. I believe I'm going to do a panel on
what's the
Friday
panel about?
As well. I think finding value in a down market type thing, or finding growth, or something to that effect. Right?
Do you remember offhand who's going to be?
I don't have the list yet. So
No.
I reached out, I said, send the list. It would be nice to see. Maybe it's up on the website now. And if anybody, one of you two guys can look while I'm speaking right now, we can find that out. That would be great. But and we'll put it in there, who's going to be on the panel. It would be great. There's last time we had Gordon Pape, I believe, and Contra the Herd guy. I can't remember his name right now. Sorry. But Benj Galander, I think, was on that. And I've been on panels with various people in the past there. I believe the lead singer of Kiss was on one. So that was an awesome panel, to be honest. It was good. But I like to, I like to keep it light, but then we'll have some great recommendations here. I remember 5 years ago we recommended Expel on the panel there, and it was trading around $5 after that was in the September period, and we had recommended to clients just a year before in like the $1.40 period. It had jumped by March to $3, and even at $5, it was probably cheaper on an earnings basis than it was on our original recommendation because of the huge jump in earnings. But those are some companies that we have in our existing research that we may throw out there. So I encourage investors that are in that area come out and listen to us speak there, and we'll tell you how to, not only what we think in terms of the valuations of the current market, a couple companies we like right now. Obviously, our current clients already know those companies, and then we'll talk about how you simply put together that portfolio, that 15 to 25 stock portfolio that we advise our clients to put together each year.
Yeah, so I found it here. I found it here. If I could just quickly.
That's how you tap dance while someone finds. Right?
Exactly. So it's finding winning stocks even in a bear market, and you are along with Peter Hodson, Gavin Graham, and Benj Gallender.
Wow.
So that
is
all-star
cast.
Well, I know all three of them.
Yeah.
We may end up just rolling around on the ground and fighting. You never know. I don't promise that.
You'll sell more
tickets.
tickets.
If Aaron gets in on time, he can join in too.
You'll sell more tickets. I'll just doing everything and putting it on our YouTube channel.
Yeah.
Perfect.
Which will get the most
looking forward to it because, Ryan, you've spoken recently, somewhat recently at the Vancouver conference, Cambridge conference. This will be the first time for me speaking in front of a live audience since the pandemic started, so I'm
They've
really
been mostly dead audiences.
Yeah, hopefully there'll be more than 3 people there.
No,
but,
I know.
It'll honestly it'll be great.
500 people, so it should be good.
The Money Show does a great job of organizing the conference, and
getting people.
I'm sure it's going to be fantastic. So being that it's the first time back, I'm gonna try and do something that's.
Aaron's gonna be on point.
I'm gonna be making fun of Ryan the whole time,
right?
Yeah.
Yeah.
Well,
that's low hanging fruit, though. Come on, that's easy to do. So, do we have anything else we want to discuss before we get into this massive debate?
Just really quickly.
Brennan looks nervous. I don't know.
Brennan, you're nervous?
Yeah.
I'm not nervous. No.
No.
I was just quickly going to bring up. We were talking about interest rates going up. Inflation potentially coming down. We are starting to see housing prices come down a little bit. Brett will quickly flash up on the screen here. This is from a Bloomberg article that I just recently saw, where the headline is "The world's hottest housing markets are facing a painful reset." So on this graph that I'll get Brett to show up essentially. Like the Toronto housing market is still up 45% since the beginning of 2020. So, I mean, they're predicting that housing prices are planning on coming down, double-digit price declines as consumers face mounting financial pressures. We'll see. But it just is interesting that we're starting to see some of these more volatile markets start to turn over. I'm personally looking for a home myself in Saskatoon. We clearly don't have.
Pardon? That sounds like a made
up place. Hot market, all right. And Ryan thinks that it's made up. No, it's not made up, Ryan. Even though you tell everyone that you go to conferences. It is.
Have you ever been?
Beautiful place.
Right?
No, I just.
Then how do you know it's a beautiful
I looked
place?
on Google Maps.
I've been a couple of times, Brennan. It's wonderful.
It is a beautiful city. I mean, especially when it's not minus 40.
We have clients out there, so I say it's just gorgeous.
But I've been trying to price the market a little bit, and I haven't seen housing prices come down too much. But it will be interesting to see where we see prices go
on
here.
that chart that we're looking at, like Sydney, Auckland, and Stockholm have already rolled down more significantly. Toronto is just nudged down slightly in terms of where it got home prices like from 2020, January of 2020 to where they are just starting 2022. Now, it would be this is just starting 2022, it looks there. So it'd be interesting to know if we extended that out for the first 6 months of this year.
Yeah. I mean, I don't think it should be any surprise that real estate prices are going to pull back. I mean, you look at where interest rates are right now. I mean, what's the rate on a mortgage, on a 5-year mortgage? It's like 4.5%.
I think it's even higher now. I think. It
Oh,
might even
wow.
be
Well,
like
I mean, that was
five
unheard
Yeah,
of.
the
Inflation.
affordability index is just, it's gotten
so
far
it's
more expensive to carry.
The carrying cost has gone up a lot. So it's like, even as the prices come down for somebody who's looking to get into the market, it's like, it's great that you're buying at a lower price, but your carrying costs are going to be higher.
Yeah, unless you have a huge amount of capital sitting on the sideline, just like you know, cash.
But in Canada,
Unless you're like Brennan with that huge amount just sitting on the sidelines, right?
No.
in Canada, I think that longer term, it really comes down to a supply demand issue, because there just isn't enough supply of housing for people, and that's what's going to continue to put upward pressure on prices over time. Like, the only real solution is to increase supply so that it falls in line with demand. Otherwise, you're going to have people that don't have housing and people that have it and can barely afford it.
And Canada is just overcrowded. We just don't have enough land here. That's the issue.
Well, but the thing is that, I mean, most of it,
come to Saskatchewan.
I know there's
most of it's not.
People would say livable land. I don't know. No, there's tons.
In terms of major centers, we don't have that many. But I mean, I think that there are probably a lot of nice places that, we got to branch out into more and just start. I mean, that's how development happened in the past, right?
Yeah,
things would get too expensive in the main centers, so people would branch out. They would go and build new communities.
Yeah. Just like a little bit of a tangent here too, just as Ryan was talking about how populated Canada is. I saw an article where The Economist called Saskatchewan a remote province, and a bunch of people, there was a lot of backlash online because I don't think I'm remote. You guys might think I'm remote. Anyways, I just thought I'd bring that
compared
up.
to what?
I thought it was interesting.
Relatively
exactly.
Speaking. No,
relatively speaking.
You're not remote.
But I don't think we're remote. Anyways,
although the flights, we keep getting you flights like round to California. You got no direct anywhere. For God's sakes, get us some direct flights.
Tell me about it. It's not
for
very
you.
fun.
I mean, for you, right? Like I sympathize.
Yeah, it's not very fun.
You got to hop around to get anywhere. But anyways, all right, let's get into our debate before you just end this session in a pool of sweat.
So we're gonna try something new. I originally was set to be the judge, but we're actually gonna do a dual judging of this competition. We're just gonna workshop this, see how it goes. It may not.
I didn't know ahead of time. Like, I would have forwarded Brett some cash too. I only forwarded Aaron.
So Brennan tried the same thing on me, Ryan. I mean, I'll take the money. I'm just not gonna do what you asked. That's all.
It's true.
Yeah, I had about 5
minutes. It's not that I don't have a price.
Guys.
It's not that I don't have a price. It's just,
Do you want to flip to see who goes first here? Or
I mean, I'd kind of like to go first, but
okay, yeah, I'd like.
You can go first.
You would like me to go first.
Do you want to define LEAT here? Do you gotta?
Yeah, so I've got.
Tell them who we're talking about here. LEAT Corporation.
Yes, so LEAT Corporation, LEAT on the OTCQX. LEAT Corp is renowned for the award-winning LEAT brace, and they have since extended their range of products to include LEAT helmets, body armor, knee braces, elbow guards, and a lot of other body armor for mostly the motorcycle industry, but as well, or off-road motorcycle industry like dirt bikes, but as well they are dipping into such as just normal pedal biking, as well as they've kind of touted going into skiing as well, but those would be smaller markets. But yeah, that's essentially what the company does. They provide products like that, and they were the first to market with their LEAT neck brace, essentially, which was the first neck brace for motorcycle riders to protect them from neck injuries. So that really got them on the ground running.
Yeah, good solid revenue and earnings growth, like a company that you wouldn't hesitate to buy right now. That's what you're saying, right, Brian?
Whoa, no. Whoa. just a second here.
You said I heard yes.
Okay. So someone can.
Okay.
Yeah, I think Aaron's timing that.
I'll do the timing.
And I will try to not fumble over my
Don't be nervous.
words.
Bull versus bear. Stock battle.
Okay.
A little nervous.
Are you ready, Brennan?
I'm ready.
Go.
Ryan will likely talk about the company's solid current fundamentals, but the forward fundamentals may be in for a bit of a bumpy ride. The off-road motorcycle market received a huge COVID bump, with the US market growing by 40% in 2020, but anticipated to grow with just a CAGR of 5.5% over the next 6 years. Plus, momentum in revenue growth is slowing, with Q2 2022 revenue down 26% sequentially for the first sequential decline since June of 2020. Leatt operates in a very mature market with a lot of competition, as competitors have flooded the market with similar neck brace products, with Leatt's neck brace sales declining 18% year over year, and over 15 companies compete for market share in the helmet and body armor market. The company's products are predominantly manufactured in China, which is a risk, and the stock is thinly traded with just 5,000 shares trading hands per day. Bottom line, I wouldn't want to hold this stock after the COVID bump and into a macro environment with less consumer spending. Boom.
You've got 2 seconds left.
Brent sucks.
All right, you don't want to use that time. Okay.
Good point, Brendan.
Well, we'll see. We'll see what Ryan's counterpoints are. Ryan, are you ready?
Yeah.
Go.
Leatt is growth at a reasonable price. Despite facing tough comparables, Leatt's revenues, net income for the first 6 months jumped 55%, and actual EPS jumped 46% to 120. Q2 was the 17th consecutive quarter of year-over-year revenue growth. Has a great balance sheet, significant cash position, $5 million or 86 cents per share, $33.48 million in working capital, and basically no debt. With all this, it must trade at sky-high valuations. Wrong. Leatt trades at 8.9 times trailing 12 months earnings. Growth is expected moving forward. It is not just the financials. Leatt boasts award-winning products that meet the highest safety standards in sport. Safety is top of mind today for athletes and parents. Leatt innovates. Newly launched helmets, growth up 132% in Q2. It's unknown and on the OTC, making it textbook GARP opportunity, growth at a reasonable price. And all that came from Brennan, so I would disregard anything he said. Thank you.
Okay, 1 second. 1 second to spare. Excellent. Nice. Can I clarify something here?
Yes.
I thought I heard Brennan say that quarterly sales were down, and then Ryan was saying that quarterly sales were
that
up.
was just in one segment. Really? Because
they were only up in one segment.
Sequentially. Total quarterly sales sequentially were down for the first time since the pandemic.
But
so sequentially,
up year over year. Up year over year.
Yes. Up
so they had a bad quarter, is what you're getting at.
Yeah, well, it was up year
I would
over year,
argue
so
that
it's
they
not
had
really
a
a bad
COVID
quarter.
bump, but, you know.
Despite those tough pandemic comparables, Aaron, they still had significant growth and only trade at 8.9 times with
okay,
net
enough. Thank you.
Yeah.
I appreciate that. You're starting to exceed your time.
Yeah. Hey,
yeah. I mean, this is a tough one. What, like, do you think this is a tough one, Brett?
Yeah, it is. I will say something which Brennan didn't comment on was actual earnings as much, where Ryan did. He was saying there was 17% EPS growth.
Well, I just said they had good fundamentals. I knew Ryan was going to gloss it up because the fundamentals do look good. But forward, I think that momentum is declining. And that is a scary thing, especially when you're dealing with consumer discretionary products.
Am I caring about sales or am I caring about earnings? That's the question here.
Well,
I mean, earnings growth to me is less attractive if it's not driven by revenue growth.
So
right?
their core product, and I'll just let you know too, their core product sales were down, but their ancillary new products, they have a new helmet product just really introduced recently, but in that quarter, it was up 132% sales for the helmets.
Small base.
Head injuries.
Small base.
Aaron, you want to protect your children. Just think about this. You want to protect your children. Think about the children.
Yeah. No, I'm thinking.
Are you going to that argument?
And at 8, you're protecting them at 8.9 times earnings, and we didn't even take the cash out. It's probably 8 times when you take the cash out.
Okay, yeah. Now you're starting to exceed your time again, sir.
Yeah.
Brandon got a few comments in. Yeah, no, I think I've heard enough. It's a tough one. It's a tough one because, for some of these companies that have gotten a big pandemic bump, for some of these companies, we really have seen sales come off, and I've often said, it's worthwhile to just, especially if there's negative momentum in the stock price, just to kind of see where sales start to trend, right? Like if there's not a hurry to jump in with like a full position, why not just see how sales are trending, or maybe like build it up very slowly if it's a company that you like. Because in a lot of cases, it's the end of the pandemic was devastating financially to some companies that did very well. But they're coming out with new products.
There's still growth. And yet there's still growth.
Yeah. I heard you.
Post-pandemic.
Do we need to start issuing yellow cards here, sir?
I might have to start muting him.
No, it's all good. It's all good. After careful deliberation to this, I'm going to have to say that I call this for a draw.
No, stop.
Joking, no.
It's like kissing your sister. So, what is it, a hung jury?
No,
I think it is a hung jury.
Yeah, I think that
yeah, speak your mind.
I could call this either way.
Brett,
right?
what do you think?
It is.
I'm not calling it either way. But sure, I'll let you talk, Brett. But
yeah, something which I do. I am so on the edge here because there is just great points on both sides.
But we got to do this. We have to do this. We're wasting people's time now.
I think the thing that
people's last.
I will say mine first.
Yeah,
you can try to convince me, but I'm gonna go with Ryan.
You're gonna go with Ryan, okay?
Yeah, because he mentioned the balance sheet, which Brendan did not have any counterpoints against that. That's what's pushing me over the edge. There is they have a good balance sheet. So if they're looking at like a year of bad quarters in a recessionary scenario, they do at least have some backing towards it.
Okay.
That's what I'm getting out of it.
Okay. Yeah, I'm gonna go with Ryan as well. And it was so close though. It was so close, Brendan. I think that Brendan did do a good job. But this is also just a situation of like,
except he sucks.
I'm just kidding. You've got fundamentals in line. You've got evaluation. You've got, I wasn't, we need to be cautious that momentum is declining. And the problem is that I wouldn't just jump into a full position in this. And this is what is making it a difficult decision, right? But I think that Ryan, at least made a good enough case that I would consider, layering in to something, right? So but it was like super close.
Now that I've won. Those would be my worries, like that. Yeah, there is you could have a quarter where there's a decline in earnings per share, right? You could have,
and that's the thing.
Decline.
Like there was still.
I was very encouraged though to see the growth in the other products outside their core product, right? That was excellent to see. It shows they're innovating. I think their product is well thought of, and the name is now well thought of. Through a couple of industries now, and that helps when they bring on another product. And if you're well thought of and have great reviews, then that can help the growth in that product going forward. But yeah, like the issue is some of these companies did get massive bump ups, pandemic, stay at home, everybody went out and was biking or whatever the product was that was used more during those times. And you have to watch now. If this company had a quarter where we saw significant negative decline or revenues decline significantly year over year, then you just wait on the sidelines. But we didn't see that. So,
and I just think for a quarter position, for something to kind of start nibbling on it, net cash balance,
it's difficult to
and low valuation.
Like they don't have guidance going forward, which is something Brandon could have said.
No.
Yeah, well, but the thing is like it's tough because they've increased their international sales so much. Like they're really growing internationally now. And management has talked, like the only guidance that they've really given is we have a long runway to continue to grow into this international expansion they've been talking about.
It'd be nice to see them uplist too. Like
one of the most persuasive things that Brennan said was when he said that future growth was expected to slow and the market was going to grow at 5.5% per year. So, so that's slower growth. But obviously with the valuation, you're not expecting the current growth rate to be maintained, right? But I would say in the future, if you could find like some statement that kind of like broke things down a little bit from like like an industry report or something from like the conference call or a competitor that talks about like the industry actually, slowing, that would have helped as well.
To be honest, like a 5.5% or
that could be fine. And if they're increasing market share,
rate.
then you're at 10-15% revenue growth, maybe.
Like say in the helmet part of the market, they're a minnow right now. If they have a lot of market share to gain, then you have the case to gain market share and grow above the industry. So if you're trading at 8 point something times and you're growing, you could maybe grow double the industry, 10%. Then you're probably, even at that rate, you're probably looking at a company that it could be undervalued.
Right.
But certainly the issue is it's going to have more tough comparables going forward. So do you have a couple quarters where they have an earnings per share decline? And then, this may be a very good company, but you might have a pullback. Then that might be the opportunity to
and you will.
Buy a lot more. Right?
And you will in this market.
And
so that's why it was a good debate, we thought. We looked at it, and these were the two sides of the coin. And, when you're looking at a company like that, it's nice to actually have a good debate where you have two judges saying, either way.
Yeah, you want it to be hard, right? You don't, we've discussed, we don't want to do these debates where it's won or lost at the flip of the coin. We want each person to have, a good opportunity.
Exactly. And even though I did lose, I will pat my back. I was the analyst that pulled this stock out back at the beginning of the pandemic as a part of the LD 500 companies. And just like to quickly sum it up, I mean, it's basically exactly what Ryan said. Great valuations, great balance sheet. They started with their flagship neck brace. After that, they started providing a full neck to toe or head to toe offering. Good growth and growth to scale into. We kept the stock at a monitor, but I mean, it performed very well at that time. It was at $5. I think it's at $22 now. So it's just a good business that, great fundamentals. And, like Ryan said, textbook, GARP, or growth at a reasonable price.
Yeah. Founders, good positions in the company still as well. So it's nice.
It's another thing that's nice to see. Entrepreneurial style business where the CEO is still.
I saw their products when we were up in Whistler, right? Like it was great to see. Like
when you were riding your bike up there,
many places, backwards downhill.
Yeah, what was that? It was really a tricycle, though, right?
Wow, yeah, that's true. But
not a motorbike.
I'd like to see you get on a tricycle. All right, anyways, about that. All right, let's get to. Aaron's going to talk about a guy who rides a tricycle all the time, and that's Charlie Munger.
I could see that.
Is he not? Yeah,
I could see that.
He's at 98. It's just impressive that he's still the.
Well, I didn't even know he was 98. Like that's the crazy thing. But it's there's a few interesting things.
Yeah, I had to Google it 3 times because I knew he was. I thought it was still in the early to mid 90s, but I mean we were. That's.
We're 6 years older than Buffett,
now.
So he's a little older than Buffett. Yeah.
It's unbelievable.
Yeah.
And he's still all there, which is great.
Yeah, I mean, presumably, he seems like he is. He's going to work every day and still. Yeah. No, he definitely does. So
last time we called him up, he was.
Of course, yeah.
Yes.
So what we're going to do an investor discussion, famous investor discussion on Charlie Munger. So I'm going to share my screen, and I'm pretty excited about this because I think that Charlie Munger, I always kind of thought maybe he doesn't get the credit he deserves, even though he does get credit, he certainly gets it. But whenever you think of Berkshire Hathaway, it's always Warren Buffett. Warren Buffett's the greatest investor ever, certainly one of the richest men in the world. You rarely ever hear about Charlie. And it's funny because if you look at the AGM, the Berkshire Hathaway AGM, Charlie's really a man of few words a lot of the times. Like he'll answer questions just very succinctly and a couple of words. Whereas Warren Buffett, he's the more charismatic one. He makes a lot of jokes, makes people laugh. But I always thought maybe Charles is more the brains behind the operation than even a lot of people think. So I learned a few things about him. Mostly positive, and one thing at the end that I'll talk about that I disagree with what he said, but let's just get into it. So a couple of quick facts from him. Born in Omaha, Nebraska in 1924, so he's 98 years old. Crazy, like that he's still going to work and he's still doing such a stand-up job at 98. I mean, that's fantastic. Estimated net worth of 2.1 billion. So, less than Warren Buffett, who I think is upwards around like 60 billion. One of the things I didn't know about Charles Munger is that he's a World War II veteran. He served in the U.S. Army Air Corps from 1943 to 1946. He was a junior second lieutenant. Now, couldn't find a lot of information about his actual service, if he was in combat or anything, but he did serve during World War II. Graduated Harvard Law in 1948. Afterwards, he entered practice as a lawyer. He had his own practice. He began investing with Warren Buffett, I believe it was around like 1965, 1967 range. But actually, him and Warren go way back because he worked as a teenager for, I believe it was Warren Buffett's grandfather's company. So I'm sure that they knew each other even way back then. Buffett and Son, yeah. And currently vice chairman of Berkshire Hathaway and known as Warren Buffett's right-hand man. And he came to this position in 1978. So one of the best ways, I think, to really understand an investor is to look at their portfolio. And this is Charlie Munger's personal portfolio. It's really not very exciting. Not at all. There's 4 stocks in here. Costco, you hear a lot about him loving Costco. He talks about it all the time. He's a director for the company. It's a 90 million position. But about 95% of his portfolio is in Berkshire Hathaway. About 1.9 billion of the 1.88 billion of the 1.98. And he also owns a position in the Daily Journal, which from what I can tell, it's basically acting right now as a holding company. So he manages the portfolio of the Daily Journal. The investment portfolio, it's worth a little less than $200 million. And this is what that portfolio has. Once again, nothing too exciting here. 5 companies: Bank of America, Wells Fargo, Alibaba, US Bank Corp, POSCO, ADR. So, really not focused on casting a wide net, obviously. Now, if we look at the top 5 holdings of Berkshire Hathaway, so these are the top 5 holdings and the percentage that each of those companies accounts for of the invested capital. And Apple, 42% of the invested capital. So this is in publicly traded companies. The entire portfolio, I believe, is around 450 billion or so. And it's there's about 120 billion in cash or so as of the last reporting in June 30th. So Apple, 42% of the stock portfolio, Bank of America, 10%. So the top 5 companies together account for 75% of the total invested portfolio. So obviously, very focused investors, and this is really part of the of Munger's and Buffett's strategy. It's a big part of their strategy where they don't like a lot of activity. They say like the less activity, the better. Don't be active just for the sake of being active. And they're talking, to traders out there, to people that are constantly looking at the ups and downs in their portfolio and thinking, should I buy? Should I sell? Should I make changes? Just a quote from here. He says there's huge advantages for an individual to get into a position with just a few great investments and sit. You're paying less to brokers. You're listening to less nonsense. If it works, the government awards you. And that's true. Traders will generally pay more in taxes if they're making money. He's saying the 1 to 3% percentage points compounded, which makes a big difference over time. So this is a key part of the strategy at Berkshire, is to make a small number of bets and really focus your capital into the companies, a small collection of companies that you believe really stand above the others. Make those bets count. So Charlie Munger he's very focused on learning. This is something that I heard from Warren Buffett too. These are guys that read all the time. One of the quotes here: in my whole life, I've known no wise people over a broad subject matter area who didn't read all the time. 0, none. You'd be amazed how much Warren and him read. Says he gets laughed at by his children. He reads so much. And, he's really focused. He talks a lot about having a wide range of knowledge, like being knowledgeable on a wide range of different things. And this is something that is, of course, very important to a stock picker or an investment manager, because you may be researching companies in a wide range of industries. You could be researching a manufacturing company one day, another day a technology company. So having good knowledge in a wide range of areas really helps you understand what these companies are doing, what the opportunities and what the risks are. But another thing that he really has talked a lot about is the use of mental models. So a mental model is really, it's an explanation of how something works in the real world. And often it's used to predict the future. or try and predict the future, try and have an understanding of what's going to happen based on the current situation and what's going on. And it's also, mental models are also used to help you understand your own biases. So he's big on developing a collection of mental models. Mastering multiple mental models which underlie the reality is the best thing you can do, essentially, he says. And he's provided examples as well. So mental models can be hard science or engineering, like, for example, like the laws of physics. He talks about the engineering idea of a backup system as being a very powerful idea. The engineering idea of breaking points, the concept of critical mass. He's talked about Coca-Cola and Disney and how they were able to develop a critical mass in their own business to become successful. And what he thinks people need to do is they need to develop these different types of mental models, and they need to connect them together in a lattice work. And he calls it Lollapalooza. He says you get Lollapalooza effects when 2, 3, or 4 of these forces are all operating in the same direction. So you have these mental models on how the world works, how different companies and business models operate, and you connect them together in order to make good, wise decisions and intelligent investments. So mental models it's not just about the laws of science. Also, simplicity is a main focus of his investment strategy. One of the greatest ways to avoid trouble is to keep it simple, he says. The system often gets out of control. So that is a mental model as well, as that if you increase the complexity of a system, and a system can also be, an investment strategy or a thought process, as you increase the complexity of it, it becomes more difficult to understand, and you're introducing a lot of risks and a lot of problems. Simplicity has a way of improving performance by enabling us to better understand what we're doing. And he says we have 3 baskets for investing, and this is really good. He says yes, no, and too tough to understand. So if something violates the simplicity principle and he doesn't understand it, he doesn't invest in it. And obviously, from looking at his portfolio, we can tell that most of his decisions, the vast majority, are in the no or the too tough to understand. Very few times does he say yes. Now, he's been very outspoken on Bitcoin and cryptocurrency, very serious on this subject. He thinks that it is discussed. One of the quotes here, I think I should say modestly, that the whole damn development, being crypto and Bitcoin, is disgusting and contrary to the interests of civilization. Another one, in my life, I try to avoid things that are stupid and evil and make me look bad, and Bitcoin does all 3. So very outspoken against Bitcoin. Now, I really see eye to eye on a lot of what he says. I think about 95% of what he says is spot on, particularly with the learning, with the developing mental models, with understanding your own biases. He talks a lot about that. So anybody who wants to learn more, go on YouTube and listen to some of his discussions. He's not as charismatic or as funny as Warren Buffett, but he's a very good speaker. But one of the things I did come across was an article from Reuters in June of 2021, where he was talking about the Communist government of China's policy with respect to Jack Ma and essentially the disappearance of Jack Ma. So he made some statements there where he basically said that he thought that the communists got it right, that they basically called Ma up, said, "You're not doing this, Sonny," and he thought that was great. Another comment about how he wouldn't take most things from the communist government, but he really likes the way they run their financial system. I think that those comments, I'll go as far as to say that they're somewhat ignorant comments. I disagree with them. In terms of he was talking about Ant Financial and Jack Ma's company, and how he felt that encouraged speculation. And he thinks that should be clamped down on. I can't comment as to the extent that everything that Ant Financial is doing and the products that they were offering, but I don't necessarily think that some speculation is a bad thing. I mean, not everybody can be a fundamental investor. Not everybody can be a value investor. I think the market works when you have different types of investors with different time horizons, with different outlooks and different approaches to investing. But then also just the comments about, they call them in and they said, "You're not doing this, buddy." I didn't like that, because I don't think that it was likely an accurate description of what happened. I mean, here you had somebody who was very much in the public eye, and that he made a criticism, and then he disappeared. So I didn't like those comments, but overall, I really enjoyed researching Charlie Munger. And like I said, about 98% of what I read, that he said or talked about, I really agreed with.
Awesome.
All right.
Good. And I learned something. I thought Lollapalooza was a music festival.
It is.
I know.
It is. Yeah.
Did you ever go? That's what I want to know.
No.
I don't think I ever went either. But
where does it held? Where is it?
He doesn't remember. I don't know. I thought it moved around. Right?
Oh, okay.
But I mean, maybe one of our listeners.
Ryan doesn't remember. That means he probably did.
I looked up. There's one in Grant Park in Chicago on August 3rd and 6th, 2023. So we can start booking our hotel packages and our flights now if you want.
Right. Yeah.
Aaron, you're in?
I'll check with my wife and kids.
Yes. No, that was a good.
If they say I can go, then I'm in.
It was a good summary. Did you anything else you dug up on them that you didn't want to discuss that we're gonna pull out of you now, or anything else interesting?
No, not really. I just and I should also say maybe he had a different perspective when he was making his comments on the Jack Ma situation. I just think it's somewhat of a crazy situation that somebody that's so high profile disappears like that. So he might have had a different perspective or wasn't thinking about it in that way, but yeah, that was really the only thing
I mean the focus portfolio is really the thing that I mean there's so many things to take away from the way they do their business, right, him and Warren, but the focus portfolio, when you hear like the rest of 90 something percent of financial advisors talk about diversification, right? And then you see like his holdings, and obviously Berkshire is diversified, but I mean the way that in their and we've seen Warren himself's personal portfolio before, like it was 70 something percent was in 8 stocks, right? Like it's just they believe in doing a hell of a lot of research and putting your money where your mouth is and not owning 50 stocks or 100 stocks or 10 mutual funds that all own 200 stocks. It's just it's a way of investing based on your conviction, and if you're going to do all that research, why not make a bet that actually, it's not a bet, why not make an investment that actually matters, right? So,
make your winners count is the
of course we talk about
their
that
principle
in our seminars all the
and
time.
I'll admit I've never had 40% in one stock before myself. That's a little focused even for me, but the concept,
for sure.
And one of the things you never I would say, don't try and copy what Charlie Munger or what Warren Buffett do. Don't try and copy that. Take the principles like that, and like the mental models, like you said, but the principles, and then understand those principles deeply, and then apply them to your own strategy. Because what works for them, I mean, most of what Berkshire Hathaway does is buys entire businesses. They operate like a conglomerate inside of an insurance structure, company structure. So it's but they do have that publicly traded stock portfolio as well. And there's probably about, I don't know, I didn't count, about 30 companies in it. But as I showed, the top 5 accounted for 75%.
Yeah. Which is the key takeaway, really. Like they're also like Apple wasn't always 42% of the portfolio.
No,
it's made tremendous gains in that portfolio, and they've held on to. I mean, they've sold some, but they've held on to. And it's that, I think that's the key part. Like they didn't just buy 42% in Apple. They've allowed it. And it's one of the things that can be really difficult as an investor. As you see a company really doing tremendous in your portfolio, becoming 5, 10, 20, if it comes to 30% of your portfolio, can you still look at that situation and say, it still offers value. If I saw it today, I'd buy it. So you're still continuing to hold, right? And having the discipline to do that. They have over time. It is a good thing to be able to do as an investor. It can be difficult when you're staring like 40% of your portfolio in one company, even if you think it's a great company, right? It is having a higher level of risk tolerance. We're
not advising that. We're advising for your actively managed portfolio, 15 to 25 stocks, right?
Yeah.
But that's certainly a lot less than what many advisors
you're
suggest.
Just many are just having you buy the market, and this is what we talk about in our seminars. And by the way, we're gonna launch into seminars at the end of next month, early into November. So we're gonna do a couple in person, so we'll have news on that coming out, and we'll do our webinars too. We'll do 2, one for the West Coast and one for the East Coast markets. And So we'll have some more information on that in upcoming podcasts as well.
Going back, if I could just revert back to Warren and Charlie here. About just over a year ago, I wrote an article on our website. It's on our blog. And essentially why I wrote it is I watched the HBO documentary called Becoming Warren Buffett. And Warren kind of goes into how Charlie's strategy and his own strategy are a little bit different, where Warren would primarily uncover stocks that were trading at deep discounts to the market, frequently gravitating towards small caps, where Charlie, on the other hand, and this is something that Warren speaks very highly of Charlie teaching him, is finding a business with an economic moat and a business that isn't necessarily trading at a deep discount, but more at a fair value, but is growing, at a good clip over a long period of time. Anyways, I just kind of wanted to pose those two strategies.
Yeah, no, and that's that kind of it's stuff like that. It's things like that make me think that maybe, he has been more of a driving force behind the success of Berkshire Hathaway. And I don't have exact numbers, but one of the reasons why he has so much less money, I understand to be that he's made a lot of his charitable donations while alive, whereas Buffett is planning to donate, I think, virtually all of his fortune, but that's after his death. So that's one of the reasons why he has less money. And this comes down to the statement you made, Brendan. This comes down to the quote that I've heard from probably both of them, that I'd rather buy a great company at a reasonable price than a bad company at a great price, right?
Yeah. No, it's everybody should hear that and think about that when they're making any investment, really. Yeah, you don't want to just buy the cheapest stock out there.
No.
You want to buy a great business, good business at a reasonable price, not necessarily the cheapest. So let's move on. Brett's going to talk about, I think that's it, right? We've done our bit on Munger. Magnet Forensics Inc., MAGT on the TSX. Brett, take that one away.
It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Yeah, here we are. This was from a viewer. We commented on them a couple weeks ago as well, and this is just a follow-up on a deeper description of the company and what they're specifically going through. As Ryan mentioned, Magnet Forensics, symbol MAGT on the TSX, is a developer of digital investigation solutions serving over 4,000 enterprises and organizations in over 100 countries. They develop tools to investigate cyber attacks and digital crimes. For the most recent quarter, Q2 2022, Magnet Forensics has had revenue of $23.1 million, an increase of 41% year over year. The annual recurring revenue increased 49% to $73.7 million. Revenue had a great year over year, but the same cannot be said for net income or adjusted EBITDA. Net income came in at a loss of $1 million versus a profit of $1.6 million in the prior year. Adjusted EBITDA fell 20% to $3.5 million. The reason for the fall in income and EBITDA was primarily the increased research and development costs as well as sales and marketing expenses, both of which were in the prior year lower due to the pandemic. However, one of the key expenses not included in the adjusted EBITDA was share-based compensation, which rose nearly 300% to $1.9 million as a percentage of sales. Share compensation was 8.2%, which is not absurdly high for a SaaS company, but would still be high compared to many other segments. As well, companies tend to have heightened share-based compensations post-IPO, which Magnet Forensics did have in 2021. Going forward, we need to monitor the share compensation if it stays high or if it starts to trend lower. For more information on the dynamics of share-based compensation, watch Aaron's previous segment on it, which I'll put a link to in the description. Clearly, the company is growing its top line and was profitable in 2021 when it reduces development costs, but that does not mean it can consistently produce profit and grow at the same time. One thing that I will be watching going forward in the coming quarters is a return to profitability while still having the suitable research and marketing costs. Something Magnet does have, though, is a strong balance sheet. The company holds $116 million in cash while only having $7.9 million in debt and leases. The company does provide guidance through the end of 2022. they estimate revenues of $92.5 million to $94.5 million, and adjusted EBITDA of $13.75 million to $15.79 million. Both of these imply the remaining half of the year will have growth in revenue and EBITDA compared to Q2. Let's take a look at what you are currently paying for the high revenue growth and potential adjusted EBITDA growth. The company has a trailing 12-month price-to-sales ratio of 2.7 times and a forward price-to-sales ratio using the management guidance of 2.4 times, as well as a trailing enterprise value to adjusted EBITDA of 8.8 times and a forward of 9 times. These are by no means criminally overpriced or underpriced metrics, but moving forward, I would like to see a return to GAAP profitability through expansion of profit margin, not just sales growth. All right.
And that concludes.
Yeah, that
so you love it.
Yeah, I mean, Magnet just good revenue growth, but it looks like revenue growth is declining, and then there's a lack of accounting profitability, even like on an adjusted earnings basis. It's certainly not cheap, and when you see declines in terms of growth, I looked at analyst estimates out there, but I think it's let me look here again. I thought they had like maybe 40 something cents next year. That's an adjusted earnings figure, unless I'm mistaken. So like on an accounting earnings basis, I'm not even sure if they're going to be profitable, right? So
well, when we that's
average estimate is 34. I mean, that's got to be an adjusted figure looking at their numbers right now, unless something like changes significantly. So yeah, I mean, I would take the PE that might be out there with a grain of salt on the company right now too, because it's certainly off of an adjusted figure.
Yeah, and as we talked about, Brett mentioned that we did a share-based compensation. Had a share-based compensation discussion a couple of weeks ago. It you have to look. So 8.8%. From a lot of these companies, share-based compensation is actually their largest expense. Yet they ignore it when they calculate adjusted earnings. So it's important to know, how much does that really change the financial picture? If you go with just the management adjusted figure that ignores share-based compensation, what is the difference between that as opposed to considering share-based compensation to be a real expense, as many investors, including Warren Buffett, think is absolutely necessary. If it changes the financial picture significantly, then you have to really consider whether or not the company is profitable.
For sure. Okay, and I think that'll end off. Brendan, you got anything else to say?
No,
I
do not.
You fell asleep. Sorry.
I did fall asleep. Yeah. Sorry, Brett.
I thought so. It's okay.
No
worries. Okay, well, anyways, if you're in Toronto, in the area there, we're going to be at the convention center downtown on Friday and Saturday. Come out. I would love to shake your hand and listen to us talk there. And keep hitting the subscribe button. I got it this time. If you're on YouTube, go onto YouTube. Watch us on there. You can see our ugly mugs actually doing this. If you want to rate us and review us on iTunes, get in there and do that for us. Subscribe, and we'll keep pumping out the content on a weekly basis. I'd like to thank everybody for listening and watching, and wish you all profitable investing.
Thank you all.
Thank you.